The global economy is at a crossroads this week, and the decisions being made in boardrooms from Washington to Frankfurt could reshape your investments, your job prospects, and your financial future. I'm talking about interest rate cuts, unprecedented trade uncertainty, and economic signals that are keeping world leaders up at night. But here's what the mainstream media isn't telling you. While everyone's focused on political headlines, the real story is unfolding in central bank meeting rooms and international trade negotiations. These decisions will impact everything from your mortgage payments to your retirement fund, from job availability to the price of goods in your local store. I'm about to break down 4 massive economic developments that happened just this week, explain exactly why they matter, and most importantly, give you actionable strategies to protect and grow your wealth in this changing landscape. Stay with me for the next few minutes, because by the end of this video, you'll understand exactly what these developments mean for you and your money, and you'll have a clear action plan moving forward. Let's start with the biggest story. And I mean the story that will define the next 6 months of global finance. The Federal Reserve is about to make their first interest rate cut of 2025. And this isn't just another routine adjustment. After months of holding rates steady at restrictive levels, they're responding to what insiders are calling concerning labor market deterioration. Now let me give you some context that most financial news completely misses. The last time the Fed made their first rate cut after a prolonged pause was in 2019, just months before the pandemic hit. Before that, 2007, right before the financial crisis. I'm not saying we're heading for disaster, but the Fed doesn't cut rates when everything's going perfectly. Here's what's really happening behind the scenes. The Fed has access to economic data that the public won't see for weeks or months. When they signal a rate cut, they're essentially saying, we see problems coming, and we need to act now to prevent them from getting worse. So what does this mean for you practically? If you're carrying variable rate debt, credit cards, home equity lines, adjustable rate mortgages, you're about to get some relief. But here's the catch. If you're a saver relying on high-yield savings accounts or CDs, your returns are about to drop significantly. And if you're thinking about refinancing your mortgage or making a major purchase, timing is everything. Rate cuts don't happen overnight. There's usually a 30 to 60-day lag before you see the benefits in consumer rates, but smart money is already positioning for this change. Historically, the first Fed rate cut in a cycle triggers what we call a risk-on environment. Stock markets typically rally, especially in sectors like real estate, utilities, and dividend-paying stocks. But, and this is crucial, not all rate cut cycles are the same. Sometimes they prevent recession, sometimes they simply delay it. If you're an investor, this is decision time. Do you increase your stock allocation betting on the traditional rate cut rally? Do you move into REITs expecting real estate to benefit? Or do you stay defensive, recognizing that rate cuts often signal economic weakness ahead? We'll come back to this dilemma in our action section. Now let's fly across the Atlantic to Europe, where the European Central Bank is dealing with what economists call the impossible trinity, trying to manage growth, inflation, and currency stability all at once. The ECB just revised their 2025 growth forecast, up from 0.9% to 1.2%. Now in the world of central banking, a 0.3% revision is huge. It suggests they're seeing real momentum in the European economy that wasn't there just 3 months ago. But here's where it gets interesting. This growth isn't evenly distributed. Germany, Europe's economic powerhouse, is still struggling with industrial production declines and energy costs. Meanwhile, southern European countries like Spain and Italy are showing surprising resilience, driven by tourism recovery and services sector growth. The real story, though, is inflation. Core inflation is still running at 2.4%. That's above the ECB's 2% target, and it's sticky. This puts ECB President Christine Lagarde in an impossible position. Cut rates to support growth, and you risk inflation spiraling higher. Keep rates high to fight inflation, and you might kill the economic recovery before it really begins. For anyone with European investments, traveling to Europe, or doing business there, this matters enormously. The euro has been strengthening against the dollar this week, partly because markets believe the ECB will keep rates higher for longer than the Fed. If you're planning a European vacation, your dollars won't go as far as they did 6 months ago. If you own European stocks or ETFs, Currency fluctuations could significantly impact your returns, regardless of how those companies perform. But here's what's really concerning European policymakers. Housing costs are driving much of this inflation. Sound familiar? Just like in the US, housing affordability is becoming a political issue across Europe. Young voters in France, Germany, and the Netherlands are increasingly frustrated with housing costs, and that political pressure is influencing economic policy decisions. Now we get to the story that should be dominating every financial news broadcast, but somehow isn't getting the attention it deserves. According to the UN Conference on Trade and Development, global trade policy uncertainty has reached what they're calling unprecedented levels in 2025. Let me put this in perspective. We're not just talking about the US-China trade relationship anymore, though that's certainly part of it. We're seeing trade disputes between allies, sudden shifts in subsidies, unexpected tariff announcements, and what economists call weaponized trade policy across multiple continents. Just in the past month, the European Union announced new digital services taxes affecting US tech companies. India implemented sudden restrictions on agricultural imports. Japan revised its semiconductor export controls. Brazil changed its mining royalty structure. Each of these might seem small individually, but together they're creating what trade experts call death by 1,000 cuts for global commerce. Here's why this matters to you personally. Every time a company can't predict trade policy 6 months out, they build that uncertainty into their prices. They stockpile inventory, they diversify suppliers at higher costs, they hedge currency risks. All of these costs eventually show up in the price you pay for everything from your smartphone to your morning coffee. But there's a deeper issue here that affects your career prospects and investment returns. Companies are starting to make what economists call political risk a primary factor in business decisions. That means fewer international investments, more regionalized supply chains, and ultimately slower global economic growth. Technology companies are being hit hardest: semiconductors, software, telecommunications equipment. If you work in tech or own tech stocks, this trade uncertainty is directly impacting your industry's future. But it's not just tech. Automotive, pharmaceuticals, and even agriculture are restructuring their global operations based on political rather than economic considerations. For investors, this creates both risks and opportunities. Companies with primarily domestic operations might outperform global competitors. Businesses that can navigate complex trade environments effectively could gain significant competitive advantages. But overall, market volatility is likely to increase as trade policy becomes increasingly unpredictable. Let's talk about the job market, because this is where all these macroeconomic trends translate into real-world impact for millions of people. The headline unemployment rate doesn't tell the full story. Native-born worker unemployment has been climbing throughout 2025, and this trend is a key driver behind the Fed's dovish pivot. But here's what the standard unemployment statistics miss. We're seeing what labor economists call employment quality deterioration. That means more part-time positions, fewer full-time jobs with benefits, and a significant increase in what's called gig economy displacement. If you're job hunting right now, you've probably noticed this firsthand. Positions that used to offer full-time employment and benefits are increasingly being offered as contract work or part-time positions. Companies are managing labor costs by avoiding the overhead of traditional employment relationships. The wage growth story is equally concerning. While nominal wages are growing at about 4% annually, when you factor in real inflation, not just the official numbers, but the actual cost increases for housing, food, and energy, real purchasing power for many workers is declining. Here's the paradox that's keeping economists up at night. Traditional economic theory says that when the Fed cuts rates, business investment should increase, leading to job creation. But in today's environment, businesses are more focused on efficiency and automation than expansion and hiring. Whether you're currently employed, job hunting, or planning career moves, understanding these employment trends is crucial. Industries that can't be easily automated or outsourced, healthcare, skilled trades, specialized services, are likely to offer more stability. But even in these sectors, the nature of work is changing rapidly. Before we get to your action plan, I need you to understand something crucial that most financial education completely ignores. These 4 stories I've just covered aren't separate events. They're all connected in ways that can amplify each other's effects. When the Fed cuts rates, it affects global currency flows, which impacts European monetary policy, which influences trade relationships, which affects employment patterns worldwide. It's not linear, it's exponential. Small changes in one area can create massive effects elsewhere. This is why traditional financial advice, buy and hold, diversify across asset classes, might not be enough in today's interconnected world. You need to understand these relationships to make informed decisions about your financial future. Alright, so what do you do with all this information? I've just given you a masterclass in global economic analysis, but analysis without action is worthless. Here are 7 concrete steps you can take this week. And I want you to pick at least 3 that apply to your situation. Immediate financial actions next 7 days. First, debt management strategy. If you're carrying high-interest debt, start researching refinancing options now. Don't wait for rate cuts to be announced. Call your lenders, check online refinancing platforms, and get pre-qualified. Rate cuts take 30 to 60 days to trickle down to consumer rates, but early preparation puts you at the front of the line. Second, emergency fund review. With employment uncertainty rising, now is not the time to have a weak emergency fund. If you don't have 6 months of expenses saved, make building this your absolute priority. But here's the twist. With rates about to drop, don't just stuff this money in a regular savings account. Look into treasury bills, high-yield money market accounts, or short-term CDs that you can ladder as rates change. Third, investment portfolio rebalancing. This is crucial, and most people get it wrong. Rate cuts typically boost stocks, but not all stocks equally. Historically, utilities, REITs, and dividend-paying stocks benefit most. Growth stocks can rally initially but often face pressure if rate cuts signal economic weakness. Review your allocation. Do you have too much in cash earning nothing? Are you overweight in sectors that struggle in rate-cutting environments? Medium-term strategic moves. Next 30 to 90 days. Fourth, career protection and advancement. Given the employment trends I discussed, this is the time to make yourself indispensable. Update your skills, strengthen your network, and if you're in a vulnerable position, start exploring options before you need them. But here's the opportunity. Economic uncertainty creates demand for people who can navigate complexity. Position yourself as someone who understands both the technical and economic sides of your industry. Fifth, geographic and currency diversification. With trade uncertainty at unprecedented levels, having all your investments in one country or currency is increasingly risky. This doesn't mean you need to become an international finance expert. Simple ETFs can give you exposure to European markets, emerging economies, or commodity-based currencies, but understand the currency risk you're taking. Sixth, real estate strategy review. Interest rate cuts typically boost real estate values, but trade uncertainty and employment concerns could offset this benefit. If you're thinking about buying, understand that you might be competing with investors betting on rate cut benefits. If you own property, consider whether refinancing makes sense, but also evaluate whether your local market faces specific risks from trade policy changes. Advanced opportunity positioning. Seventh, contrarian opportunity identification. Here's where sophisticated investors separate themselves from the crowd. Everyone expects rate cuts to boost stocks and hurt bonds. What if they're wrong? What if rate cuts signal deeper economic problems that stocks can't ignore? What if trade uncertainty accelerates deglobalization trends that benefit specific sectors? Start researching companies and sectors that might benefit from global supply chain restructuring. The information advantage. But here's your biggest opportunity. Staying informed in a world where most people only read headlines. Economic changes create wealth transfers. Money doesn't disappear, it moves from those who don't understand what's happening to those who do. This weekly analysis I'm providing isn't just news, it's your competitive advantage. While others are reacting to yesterday's headlines, you're positioned for tomorrow's opportunities, community engagement, and speaking of staying informed, that's where you come in. I need your help to keep bringing you these deep dive economic analyses. If this breakdown helped you understand the global financial landscape and gave you actionable strategies, smash that like button, subscribe for weekly updates, and hit the notification bell. But here's what I really want to know, and I read every comment. Which of these 7 action items are you implementing first? Are you focused on debt management, portfolio rebalancing, career positioning, and which of this week's stories affects you most personally? The Fed rate cuts, European inflation, trade uncertainty, employment trends? Drop a comment below and let's discuss how these global trends impact your local situation. I want to feature some of your questions and insights in next week's episode, so make them thoughtful and specific. Let me bring this comprehensive analysis together for you with the big picture that most financial media completely misses. This week represents what I believe is a fundamental shift in the global economic paradigm, not just another cycle, but a structural change in how the world economy operates. We're witnessing the end of the post-2008 era of ultra-low interest rates and unlimited quantitative easing. The Federal Reserve's pivot to rate cuts isn't a return to easy money. It's crisis management in a world where traditional monetary policy tools have diminished effectiveness. Europe's inflation persistence despite economic weakness signals that central banks are losing control of the inflation narrative. This isn't temporary. It's the new reality of deglobalized supply chains and geopolitical risk premiums built into every price. The trade uncertainty I've described isn't just policy turbulence. It's the unwinding of 30 years of globalization. Companies, investors, and workers who understand this transition and position accordingly will thrive. Those who don't will struggle. And the employment picture? We're not just seeing cyclical unemployment, we're witnessing structural changes in how work gets done, who does it, and what it pays. The social contract between employers and employees is being rewritten in real time. The opportunity in uncertainty. But here's what I want you to understand. Uncertainty creates opportunity. Every major wealth-building period in modern history has occurred during times of economic transition. The question isn't whether these changes will affect you, they will. The question is whether you'll be positioned to benefit from them or be victimized by them. The 7 action items I gave you aren't just suggestions, they're your roadmap to navigating this transition successfully. But knowledge without action is worthless. You can understand every economic trend perfectly, but if you don't act on that understanding, you're just an informed observer of your own financial stagnation. Looking ahead. Next week, I'll be diving deep into sector-specific opportunities created by these global trends. Which industries will benefit from supply chain reshoring? How can individual investors profit from the infrastructure spending that these economic changes will require? What specific companies are positioned to thrive in this new environment? But more importantly, I'll be analyzing whether the Fed's rate cut strategy will actually work, or if we're heading toward what some economists are quietly calling the policy error of the decade. The global economy never sleeps, and in today's interconnected world, neither do the opportunities it creates. While others are getting their economic news from 30-second social media clips and sensationalized headlines, you're getting the deep analysis and actionable insights that actually matter. Stay curious, stay informed, but most importantly, stay ahead of the curve. The next economic cycle is being written right now, and you get to choose whether you're a victim of economic forces you don't understand, or a beneficiary of changes you saw coming. I'll see you next week with another comprehensive breakdown of the financial forces reshaping our world. Until then, keep building your financial knowledge, because in an uncertain world, understanding the game is your best investment. And remember, if this analysis changed how you think about your financial future, share it with someone who needs to hear it. Financial literacy isn't just personal wealth building, it's economic empowerment for everyone who's willing to put in the work to understand how the world really works.